So.
All right, waiting for my fellow panelists to come. This is quite a beauty pageant. I'm clearly not the most beautiful, but it's okay. So I'm Gary DeWall. I'm proud to be a trustee of IFM, which is one of the sponsors of this event. Again, like Chris, I'd like to thank Fannie Mae, Georgetown Law School, obviously, it's called the Institute of International Economics, and my panelists. So immediately I've got Gordon Liao, who's the lead emerging fintech. I'm sorry, he's the chief inaugural economist of Circle. Next to Gordon is Douglas Duncan, chief economist, senior vice president of Fannie Mae. And then last but not least, all the way down there is Cindy Lee, chief inaugural economist. I'm sorry, she's the lead emerging fintech, Fed Reserve, San Francisco. Particularly Gordon and Cindy both came from San Francisco, so that's great. So we're going to hop right into this event. And by the way, also thank IFM for this is their 5th year of co-sponsoring this event, so very excited about that. We're going to jump right into this with some macro issues. Let's start looking at crypto as a macro subject. The recent FSOC report basically criticized crypto, saying it's only out there for speculative purposes. Gordon, I know you're doing a new paper. You're thinking about this. What's your view of that topic?
I think that is quite a misleading view of even crypto today. If you think about payment stablecoin, for instance, which is what Circle issues USDC, the primary use case is for payment transactions. And if you look at the challenges that we face today in the economy for instant payment, there is an immense need for faster, better, more programmable payment. The view that even for payment stablecoins are being used for speculative activities, while that may be true, but let's think about the benchmark here. Any traditional payment system, over the vast majority of payment transactions occurring are for financial purposes. For Fedwire, which processes over $1 quadrillion a year in volume, only 2% of it is actually GDP. For FX market, $6 trillion a day of transaction volume. Roughly only 2% of that is transactions supporting trades in goods and services. So the right benchmark is not 100% of payment activities going through crypto having to be non-speculative. It's not even 50%. Rather, reaching something like 2% of activities being non-speculative, which I think we are getting there. We're not there yet, but if you look at the amount of transactions are used for cross-border purposes, and the amount of transactions are being used for Web3 payments and emerging commerce on the Web3 platforms, I think we're getting there really, really quickly. And let's remember the opportunities here for really making an impact in financial inclusion. For instance, FX remittance costs on average is around 6% according to the World Bank globally. In some corridors, it's as high as in the teens percentage-wise. Now, if you can shave out even just a couple of percentage points from these remittance costs, that could do quite a bit of good to those hundreds of millions of migrant workers, not only in the US, but globally. Now, I think also what the FSOC report misses is the incredible amount of opportunity to actually reduce risk in the financial system by unbundling payments from banking and by making credit intermediation services more market-based. Today, we're talking about housing. And as you know, mortgage is such a big, important part of supporting the housing market. But mortgages, we've seen the trend, and maybe Doug could speak more to this, has already been more commoditized, being more market-based driven rather than strictly being bank-based. I think the usage of distributed ledgers, the usage of tokenized cash, payment stablecoins, the usage of blockchain would only fasten that process of separating out payments from banking, and even within banking, separating out the credit component from the depository service component.
Let's give Cindy a few seconds to give her views on the subject.
Sure. So, Gordon, you made the point of stable coins and the DLT technologies potential in terms of reducing cost and faster settlement time, which I think is probably the driver that has underlined a lot of payment sector innovation, including stable coins. But looking at this event, we are heading this event in September of 2022, and this has been a pretty testing year, arguably for many of the players in the fintech and crypto industry. So we still need to look at financial stability issues and looking at the recent market turbulence and look at what those new data points given. Obviously, there are a lot of moving pieces, and there are a lot of new data points for us to look at when we look at the recent, for example, we talk about when we prepare for this call about the Luna Terra collapse, right? So what is the right takeaway from this, and how do we look at vulnerability? Some of this failure of stablecoin projects, they happened in the past. It's just the recent 2 years or 3 years of a rising interest and activities that really recenter, attention of regulators and media into their behavior. So we now learn a little bit more about how stablecoins can behave. I think that new understanding, new data points, new renewed concerns on potential vulnerability, that's underlining a lot of ongoing policy debate and actually in the financial industry as well.
Cindy, well, I've got you here, and we're talking about macro topics. I'm curious whether you have looked at correlations between cryptos generally and how they're behaving in this inflationary environment and this potential recessionary environment.
I have indeed, and actually there have been a growing body of research by IMF economists and other economists that has well established that the correlation between Bitcoins and digital assets and major stock market indices has been on the rise. So going back to 2017, if you are looking at the correlation between Bitcoin price and S&P 500, for example, that was pretty close to zero. Today, it has really increased to the level of 0.5, 0.6 territory, so which put it very close with the traditional financial assets. So looking back at the previous recessions and period of financial distress, that's exactly how different asset classes, including commodities and bonds, have behaved. So it looks like digital assets, just based upon recent data, start to behave more like traditional risky assets in the financial markets.
Yeah. All right. And Doug, I'm curious. Let's go down a little bit to micro. We might go back up to macro again, but let's talk about DLT and crypto in the housing industry. What's the impact, and the potential impact, might I add?
Well, I think that the essential question for households starts with industry discussion about title insurance. That's typically the place that most people go. They say there's a lot to be saved because of the fees in the title insurance space. That may be true over time, but there's like three things that have to happen. One is you have to be able to perfect ownership, right? And so this is Doug's personal view. This is not Fannie Mae's view. I think you'd have to, in the title insurance space, you'd have to have the Supreme Court say, as of date certain, all prior claims are extinguished. Now you have perfected ownership of that title in that time period. Then you have to be able to track encumbrances. So, for example, if you have a title, somebody can place a lien on that. You would have to track the placement of the lien and the extinguishment of that lien. And then you'd have to monitor any complexities that go along with that. Now, I've just picked on the title insurance space because that's typically the first place people go when they talk about that.
Let me ask you, just stop right there.
Yeah.
Why, though, because you're introducing DLT to keep track of these things, do you have to wipe out the past? I mean, isn't the past a problem every time you grant new insurance or have a title transfer?
Potentially, that's true. It would certainly make it easier, though, if you knew with certainty. You would reduce the risk related to that asset if you knew with certainty that you could track its entire time.
Sure, but you could also say, you know, as of this date, we know it's 100% correct, but you know, it's maybe built on a foundation that's weak.
Right. Yeah. I think it's about reducing the risk
right.
related to that asset. Yeah. I think for households in the mortgage space, let me give you a personal example. It's a very complex process. I closed a loan about a year ago, and at the closing table, there was an $8,400 error in the arithmetic related to that. So,
in your favor or against you?
Against my favor, yeah. And so we got that corrected. There was some tense moments at the closing table while that was corrected. Particularly for unbanked people or low-income people who don't execute on those transactions frequently. I'm in the business, so I knew how to walk through that stack of paperwork, which is still this big. In order to get to that, I think that represents an opportunity for technology in the housing space to reduce that packet of things that you have to read and understand. Thinking about the unbanked, I think the most important thing for them is whatever currency is used, whether there's a central bank digital currency or whatever, it has to be legal tender. Because they typically, those unbanked folks and lower income folks typically have fewer assets, fewer savings, so the certainty around that is a real important issue. Second, low transaction costs. Gordon talked about the transaction costs of remittances. That seems to be a place that could be attacked successfully by technology and digitization. Liquidity.
Well, hold on a second. Let's just stop there. In our prep session, Gordon, you were mentioning that in fact transaction fees, the argument around transaction fees may be somewhat misleading. That even today, the check payment agencies are actually quite popular, despite the fact that people have viable alternatives. Maybe just a second on that.
So even today, many users, I think 75% of users of payday lenders actually do have bank accounts. The problem is they prefer to use payday lending for the faster transaction, for the more immediacy. So part of what Circle is trying to solve is the immediate payment, instantaneous payment. The other part is about programmability, which is how can you provide services such as simple as an escrow service, the simplest smart contract you could write in Solidity that could serve the broader public for uses such as closing a home.
I'm sorry, Don.
No, that's great.
Go ahead.
That was one of the things that the liquidity, which the payday lenders provide sort of instantaneously, is one of those key things. You talked about stable coin and stable values. That's something I think that's very important to low-income households who have less resources totally. So being able to retain the value of those, very key to them. And then ease of understanding. It's not hard to understand what happens at a payday lender in that transaction. Easy to deal with. No piles of paperwork.
And Doug, you brought up a couple of good points about legal tender. It is important for payment stablecoin to have immediate convertibility to fiat currency, which is, for instance, USDC is convertible 24/7 with a lot of liquidity to fiat, which I think is definitely important for that seamless transaction to occur if you require to, say, pay fiat currency. In addition, I think you brought up the point about access. Here's where wallet-based systems could actually make huge improvements. For instance, 75% of USDC-enabled wallets hold less than $100, which is less than the minimum required amount for most banks. These are the areas I personally think there could be immense progress in terms of financial inclusion, in terms of supporting even housing.
Yeah. Doug, I'm curious, because as I think about the subject conceptually, I think about this great distributed ledger where you can use interplay of smart contracts where you can potentially grant mortgages. You can collect through payments on the ledger. Your accounting is easy to follow. You've got this immutable record. Why aren't those all pluses that just make Fannie Mae or other agencies just not want to run out and somehow figure out how to get the mortgage process on blockchains?
The mortgage industry is not known for innovation.
I've heard that.
The e-mortgage has been a concept as long as I've been involved in the industry, which I'm not going to say how many years that is, but it's a lot. It just has never gotten traction all the way across the industry. Lots of relationship management issues, still significant parts of doing business in the mortgage industry. There's not, I don't believe, other than the regulatory compliance issues that have to be managed, there's not a conceptual reason that shouldn't happen. But there are, I think there's north of 25 regulations that impact mortgage processes. And coming out of the 2007 to 9 crisis, we surveyed lenders and asked them, where are you investing in technology? And it was all in compliance. When in theory, from our perspective, it should be improving efficiency and passing on savings to consumers. At that time, it was regulatory compliance. We have another study coming out probably next week or so on what they're doing now to try to...
But is it, Cynthia, I see you trying to say something, so go ahead, jump in.
I have a question because this is fascinating. So in terms of those compliance, challenges, are those about data privacy? Are those about, preserving trust within the mortgage process? What are those?
It's a whole range of things, and basically it has been taking the compliance measurement and verification from paper documents to electronic documents. So in terms of cost savings, not a whole lot of cost savings. In fact, in the early period of changes, employees who were applying technology to substitute for paper were actually making paper copies and storing them in file cabinets. There's been progress on that, obviously, but much to go.
And Gordon, you had mentioned, one of the interesting aspects of blockchain, distributed ledger, crypto, is that it's actually a mitigant against the too big to fail potential of big banks. I mean, isn't that, again, part of the potential of the blockchain being a competition and not only driving efficiency on blockchain, but driving efficiency at traditional banking institutions?
Absolutely. We all seen what happened during the great financial crisis, which obviously was led by banks that are too big to fail, that some of them did have to get bailed out. And I think there's real opportunity here by unbundling banking, and part of that includes finding market-based approach that are built on blockchain, perhaps, to support important credit intermediation activities such as mortgage. And I think with the transparency that it offers, with the verifiability that blockchain offers, we could actually get to support mortgage if there's proper regulatory guardrails around it and clarities around it.
And Cynthia, I'm curious, to the extent that there are potentials in this area, is it on permission blockchains, or is there a possibility it could be on permissionless blockchains?
So I think, let's say plain vanilla, public permissionless blockchains. We all know, Ethereum, Solana as a base layer token that has supported a lot of DeFi projects. Maybe some that Gordon you have referred to in the DeFi world that would introduce some of this decentralized benefit. It has their own utilities. But to the extent that these projects will need to touch upon traditional financial system and traditional financial institutions, so players like a mortgage lender and banks, I think the inevitable question is that how do you manage all sorts of risk? How do you be compliant? How do you manage, IT, cyber, all these challenges? So to that extent, I think there is a clear advantage of permissioned public blockchain or private blockchain to solve some of those challenges. But I see, Gordon, you have a reaction.
Well, let me clarify. I think there is a differentiation between permission versus permissionless versus getting KYC and getting compliant from a KYC and AML perspective. I think you could have KYC and AML compliance in a permissionless blockchain. So look, for instance, Circle launched Variety, which is a decentralized identity verification system that allows you to bring identity information to on-chain. If you look at, companies are doing data analytics, TRM labs of the world, they're doing immense amount of tracing and tracking with great amount of information for AML compliance. So I think the concept of you have to be permissioned to be able to be compliant, I think it's not an equivalence. Those two are separate. And, I come back to always asking this question rhetorically, which is, what is the use of a Gmail if you can only email other people with Gmail accounts? Which is the same fundamental reason why I think a permissionless blockchain, but with proper guide rails, with proper KYC, could actually do quite a bit of good in the world.
Doug, how is Fannie Mae formally thinking about using blockchain technology?
We've run a couple of experiments on it to just to prove out the concept. We looked at some securities issues. At this point, it doesn't seem that the cost effectiveness is there yet, but the technologic capability exists. It's something that we'll continue to work on. We also have a working group that's looking at central bank digital currency to try to understand how that might impact the operations of the company, where in our processes or in the product space that might have an impact. So, yeah, we're trying to participate in the market development.
And I'm curious, Gordon, from your perspective, and I know you have a personal interest in this, central bank digital currency, is there a place for both central bank digital currency and privately issued stablecoins going forward?
Absolutely. I think there could be coexistence between the two. Well, if you think about CBDC, there are different types of considerations. I think retail CBDC.
By the way, Cindy is smiling when you're talking right now, so we're going to get to her. Finish your point, then we're going to ask you why you're smiling.
She's smiling.
Retail CBDC would just be too much of a lift for government to bet on multi-decade type of technology, which is why for private sector to innovate on constantly upgradable blockchain is probably more preferable. But yeah, if wholesale CBDC comes around, maybe there could be coexistence. But what is wholesale CBDC? A CBDC just means that somebody has direct liability of the Federal Reserve, in which case we already have that sort of system with FedNow, except it's only restricted to banks. So if you can open up access to the Fed balance sheet by non-banks, perhaps coupled with FedNow, that would essentially resemble a wholesale CBDC that could actually support more private sector-led efforts, such as payment stablecoins.
Cindy, some thoughts?
So the only point I'm going to make is that, again, we're in a place where innovations are happening constantly, not just in the private sector, but also by public sector players. So a lot matters. I mean, Gordon, you mentioned previously about, innovations of public permissionless blockchain. Can that use be for the purpose of identity verification? I'm sure there will be a need for that. I'm sure there will be developers and builders who are thinking about some of these solutions, which just for me as someone who has followed crypto, not for too long, but I see that has been a very interesting part of the crypto asset ecosystem. So timing matters, a lot of moving pieces, which will eventually change our view on the desirability and also how we really envision this ecosystem with the different solutions that coexist.
And I know in your unofficial, non-personal capacity, can CBDCs and private issue stablecoins coexist?
For that, I have a question mark. I see a cross-border being an area where stablecoins probably have a lot of potential, but cross-border is not, an area where public sector players cannot provide solutions.
All right, we have exactly 1 minute, so I'm going to give everybody about 20 seconds for some final thoughts. Gordon?
Well, I think in understanding this whole ecosystem of decentralized finance, of blockchain, and how it could support housing, we really should consider the opportunities to reduce risk through a market-based approach, in addition to the risks that are currently being considered.
Okay, Doug?
Agreed. I would add to that reduce costs. One of the essential challenges for low-income and first-time home buyers is the cost associated with the process. And so lots of potential to reduce costs.
Cindy?
A lot of potential, as Doug just mentioned, but also one thing that resonated with me from yesterday's panel is that the first question should be, who are you trying to serve? Then the next question will be, what is the right to solve the challenges that will help the customer reach their life goal or ambition?
Terrific. Well, thank you, Gordon. Thank you, Doug. Thank you, Cindy. It's so nice to talk to non-lawyers once in a while. Everybody have a great day. And again, Chris, you've done a great job this year, as always. Thank you, everybody.
Welcome, welcome, welcome. Come one, come all to one of the highlights of the day. I am just absolutely delighted to welcome Director
Please make your way to your seats. The event is about to begin. Please make your way to your seats. The event is about to begin.
There's no doubt that technology is giving us new ways to close the housing gap, even though there are millions of people out there who are making the functional equivalent of a monthly mortgage payment in their rent. It's actually not showing up in their credit history, and that's just a huge gap.
Desktop Underwriter, also known as DU, is our automated underwriting tool. We've automated 12 months of history in DU. We use our technology to identify those borrower payments made by check or by electronic means, like Venmo or PayPal, and then we look for the 12-month payment history or pattern within the borrower's bank account statement, which is really a great example of how Fannie Mae is leveraging digital technology to really help more renters get reasonably approved for a mortgage.
We're initially focused on the black home ownership journey, so this was a way for us to leverage data to see those folks and give them access where they're going to be successful in home ownership and actually grow the pie. And that's really what we're trying to do. You don't close the gap without growing the pie.
When we looked at the challenge, we approached it in three parts. We applied machine learning capabilities to build out the algorithms to enable us to identify the consumer rent payments. And we also worked with our fintech partners to consistently pull in that 12 months of data. And then lastly, we educated the lenders and the loan officers.
I think there's still a lot that needs to happen, not just with Fannie Mae, but frankly across the ecosystem to turn this into something scalable that is part of the machine. But it takes everybody in the chain to want to solve that problem and look for ways to really tackle the things that have stood in the way of home ownership for a long time.
Going to our next panel. You know, you heard a little bit from Director Thompson about blockchain technology, and we'll have a discussion about tokenization, not just of mortgages, but the tokenization of everything and what it could mean for the economy and for finance. So I am delighted to welcome our next panel right now.
Well, good morning, everyone, and welcome. So let me start by introducing my esteemed panel today. So I'm going to start with Karen Newman, who's the head of structured finance at Redwood Trust. Then we have Nick Carter, who's the co-founder of Castle Island Ventures. We have Rebecca Reddick, who is the general counsel for Aave Companies. And last but not least, we have Jose Fernandez de Ponte, who is the SVP, general manager of blockchain, crypto, digital currencies at PayPal. So, and I am Ramon Richards. So I am thrilled to be here with you all today. The day is off to a good start, and we're going to jump right into our panel. So, Nick, we're going to start with you. So we have in our audience people with various understandings of blockchain and tokenization. Can you share a little bit about what is tokenization? What does it mean to tokenize?
Thanks, Ramon, and thanks for Chris for the invitation. Yeah, so tokenization, in the crypto/blockchain context, has a different definition from sort of the tokenization that you might be used to in fintech and sort of the data security space. So in sort of the blockchain world, it's inserting a claim to a sort of non-native asset, and a native asset would be, some crypto asset like Bitcoin or Ethereum. A non-native asset could be anything, right? I would say the most popular tokenized thing on blockchains is simply dollars, right? People don't often consider stablecoins to be part of that sort of tokenization rubric, but there's $150 billion of them on blockchains, and all they are is a claim on a commercial bank liability, basically. It's just that they settle on the blockchain. So you've seen everything under the sun be tokenized with varying degrees of success in the history of blockchains. And there was kind of a first wave of tokenization in 2017, 18. Didn't work so well, arguably. And now we have maybe a more successful second wave. So you have, I think the thing that people got excited about was tokenizing securities and putting them on chain to take advantage of kind of the nice settlement assurances you get with blockchains, the possible fractionalization. In theory, the liquidity unlock hypothesis, I don't necessarily believe that. But the idea that maybe you get more liquidity because it's on a blockchain and sort of they're inherently liquid, again, I'm very skeptical of that. And then you have tokenized non-securities like art, collectibles, NFTs are now, representing other third-party assets, merchandise, physical things. So really everything you can imagine has been tokenized. The problem with the sort of securities tokenization is just there isn't a great infrastructure, especially from a regulatory perspective, to circulate and trade securities in the blockchain context.
Great. Thank you, Nick. Jose, I want to turn to you. And as we think about kind of major considerations and innovation that we have to think through when it comes to adopting a tokenization strategy from the perch you sit on at PayPal. Can you share your thoughts?
Absolutely. As Nick was saying, there is a concept of tokenization in the crypto and blockchain space, but tokenization has been around for quite a while. And actually, on the payments side, tokenization has been active way before crypto. As an abstraction, when you're tokenizing, what you're doing is you're getting a piece of sensitive data and you're transforming that into a piece of non-sensitive data. You're getting credit card information and you're transforming that into a random string of numbers that you can share and you can store. In payments, what we learn is that if you try to figure out what is hard and what is not hard, the technology is not hard. It was, but it's established, it's tried, it's tested, it works. What it took a while for tokenization to pick up in payments was, I would say, probably two things. The first one is the use case. So why should you use tokenization? What is the killer app for tokenization in payments? And originally, it had nothing to do with blockchain. It had to do with something for the payment nerds in the room called PCI DSS, which is the payment card industry data security standard, which sets the requirements for merchants to store confidential information about consumers. So the reason that tokenization picked up in payments was because merchants had to comply with that data security aspect, and they didn't want to store personal information. So that's where you got to what you have now and when you use Apple Pay to tokenize your card in your device. All that started with that use case that drove adoption. Once that you have the use case, the second thing that you need is the ecosystem. As we said, the technology is not hard, but to do that transaction, to use that device at a point of sale in a physical store, you need to work with the phone manufacturers. You need the point of sale terminal to be able to connect with the credit card tokenization system. You need the payment processor to be able to translate that token back into a credit card number that gets sent to your payment instrument provider. All of that took a while. And I think there are many analogies that we are seeing now in the blockchain space, and we are seeing definitely that in the DeFi space, about how the different parts of the equation get together. I'm definitely not an expert in the housing market, and I don't know which are the pieces of the ecosystem that would need to adopt, but I would imagine that that's going to be one of the milestones to overcome going forward.
Hey, Jose, one quick follow-up to our top question. When you say it took a while, what was the ballpark time frame?
I would say that since the first experiments in tokenization till what we have today, that is broad adoption that most of us don't realize in our day-to-day because it's abstracted from the consumer, I would say probably 5 to 7 years.
Okay, very good. And you mentioned housing in your answer, and it's a good opportunity, Kara, to turn to you. When we talk about tokenization, what could that mean for the housing sector? What type of things could be tokenized?
Thanks for the question, and thanks to Chris for the invitation to come and talk with you all today. I'll pick up on a couple of points that Nick actually mentioned when he was giving an overview of tokenization. As a practitioner of capital markets, I found that creativity and technology are hallmarks of innovation inside the capital markets as parties seek to construct products that are attractive to investors and find new ways to distribute risk through the system. And for decades, technologies like tranching of risk have been used inside capital markets to create attractive risk profiles and match yield needs on the investors' side. And what tokenization, meaning wrapping a CUSIP or a population of loans with smart contract technology to allow it to be traded on the blockchain, can do, as Nick mentioned, is through fractionalization offer even more bespoke exposure to risk. So I'll give you a tangible example because the conversation can get a little bit esoteric sometimes. So what if rather than buying an entire population of mortgage loans or an entire CUSIP, you were able to buy just a narrow slice of risk or inside that pool of loans a specific geographic footprint? What tokenization allows you to do through fractionalization, as Nick mentioned, is to create that even more bespoke exposure to risk. And it's not just the asset, it's also the pricing. So tailoring the risk to the investor's desired risk profile might in future allow you to tailor pricing more closely to match that risk. So rather than paying for embedded credit enhancement or other investor protections inside a security, you're able to tailor the price more closely to the risk.
Got it. Makes a lot of sense. So drilling down a little bit into housing, when we think about the closing process, can you share maybe your thoughts on where you think tokenization could play in speeding up the closing process?
Well, thank you for that question, because it's helpful to kind of ground the discussion about tokenization in reality. I think it can tend to skew a bit esoteric, particularly for people like me that like the intellectual thought process of figure out ways to integrate tokenization. So the company that I work for, Redwood Trust, is involved in both the front end and the back end of the mortgage loan lifecycle. So I'll just quickly cover both of those use cases in turn. So Redwood works with originators to buy newly originated loans, and in our experience, the process of buying a loan or of originating a loan can take around 30 days, more or less, depending on the particular facts of a particular loan. And in those 30 days, the majority of them, possibly 21, are taken up by the processing and underwriting phase of the loan. And I'm conscious that we're here in Fannie's offices talking with an audience that's probably very familiar with all of the logistical challenges of originating loans. So I'll focus rather than on the granular challenges of the origination process, just on a future use case of what tokenization might mean. So if at the point of origination, a digital asset was created on the blockchain so that an originator could ingest information to fill out the credit profile and the credit package for the borrower and receive all of the supporting documentations like bank statements and tax information directly from the source, add that to the blockchain so that not only it's immediately apparent to the borrower and to the originator what items are missing, what's been improperly ingested and needs clarification, what needs further information to get the documents that you need to move the loan forward in the process immediately, have those stored in permanent digital form on the blockchain, allows underwriters to automatically process the information and allows a loan to potentially move faster towards the closing process. Just by estimation, it's possible that making that information available to all parties automatically on the blockchain could save maybe 10 to 15 days off of the process, which is a significant improvement in the borrower's experience and in the whole loan's life cycle. And then just touching quickly on the secondary mortgage market, it takes, in Redwood's estimation, about 50 to 75 days to sell a loan after we've purchased it. And the vast majority of that time, about 30 days, potentially more, is taken up in re-underwriting the loan's information. So reperforming that process that took the majority of time when the loan was originated. If the data to support the borrower's credit profile was available on blockchain so that everyone could calculate it immediately, it's possible you could save as much as 30 days off of the process. And why that matters is that recycling capital allows originators and aggregators like Redwood to more quickly invest that money back in new loans that are created. And even more importantly, for the owner of the loan that's looking to sell it, it allows the loan to move faster off of the financing facility. And in the mortgage business, as all businesses, time is money. So the faster you're able to move that loan to the next owner, the more you're able to save on the loan. And hopefully in the future, all those cost savings can be passed on to everybody, including the borrower.
Great. Thank you, Kara. So my next question, Rebecca, I'm going to start with you, but Nick, I'd love for you to weigh in as well. There's been increased discussion, consideration about tokenized insurance. What does this mean?
I think it goes to, so thanks for the question, and thanks for y'all for being here and for Chris for organizing a great event. Tokenized insurance looks a lot like what Nick and Kara have been talking about, where you take various forms of insurance and can put them on the blockchain in a variety of different ways. I think insurance is actually one of the most challenging aspects in the blockchain and crypto space, both to get it and also how it actually can work within various different applications on the blockchain. There have been some what we call crypto native type of insurance solutions that look to pool and aggregate different types of users and their risks and find ways to backstop positions you may have in different applications that are blockchain based. So things like either on exchanges or what people would call lending protocols and the like. But I don't think the insurance industry has transformed into a super blockchain friendly. I know there are a lot of people who are working on it, but it's the same type of thing, whether you take insurance and you can then use it as a tokenized asset in the blockchain space, but also thinking about how you can tokenize various type of assets and use it as insurance too. So those, I think, are two different pieces of the tokenized insurance piece. But Nick, do you have more to add?
No, I'm fully with you. I mean, the blockchain doesn't magically make your processes more efficient. You know, and like with the exception of the crypto native insurance products, which are fairly popular, you know, insurance itself has most of the features of the entire life cycle are not happening on chain. You know, these require sort of human oversight and discretion and intervention. So they're not really that amenable to being codified, you know, and being expressed as code. So this is sort of a great example of, I would say, the pitfalls of tokenization in the blockchain context is if most of the processes are happening off-chain, the tokenization doesn't get you very much. The cases where tokenizing some asset, inserting it onto the blockchain actually unlocks a lot of value and innovation is where you can compose these contracts. You can refer to them, and you can build other things on top of these assets and contracts. And that's really the beauty of the blockchain. It's sort of like open banking on steroids, right? But for sort of securities, more regulated activities, it's very hard to actually transact these things without being a regulated entity. And so that's why we haven't seen success with a lot of, let's say legacy or TradFi assets being inserted into the blockchain. If moving it around, entails, being a regulated entity, and, putting, settlement in sort of the traditional model, then you lose all the benefits of the blockchain. So the stuff to me that's the most interesting in terms of tokenization is things that aren't treated as securities necessarily. It would be, more like commodities or collectibles or, assets, things like that.
Yeah, can I add two things to that point? So the way insurance has actually evolved in the crypto native or blockchain space doesn't look like insurance, but is sort of has some of the historical aspects of various types of insurance, and is meant to sort of link to an existing type of application. So the best example I can give, because I thought Kara giving real world examples was really helpful, is if you can participate in a type of staking mechanism that is also meant to, in the case of a shortfall event, backstop losses on a type of protocol. That's a very crypto native insurance system. It's done very well. It's been copied a number of times. And there's sort of a complementary piece of software to the original application that lets you do a variety of different things. As I said, exchanges, lending, things like that. But to give a practical example of the kinds of things Kara was talking about and what tokenization of real world assets looks like, there's a software developer named Centrifuge that has built out what they call RWA, or real world asset markets. And what they did is they have taken a real world asset market, they tokenize pretty esoteric assets like shipping receipts and the like. They put them in trusts and then they create tokens. I don't know about the tranching of risk in those in particular, but I do think that there is a lot of thought that goes into that. But what they did most recently is they built the real world asset market on top of a piece of software that our company built called the Aave protocol, which allows you to supply and borrow crypto assets. And so what Centrifuge has done is it allows you to take these tokenized real world assets and use them as collateral to borrow against them. So you can borrow something like USDC, a tokenized dollar, or you can borrow more crypto native assets like ETH and the like. But that is what, the beginning of what a real world application of these real world asset markets looks like.
Great. So Jose, I want to start with you and would welcome others to share their thoughts. So as we consider what tokenization could mean in the housing industry, could you share some of your experience from the payment space, lessons learned, things that you all have discovered that would be helpful insight as we think about it?
Happy to, and I'm learning many parallels from the other applications on housing and insurance that I think that would apply in payments as well. So the first one that as an industry I think that we learned the hard way is that a payment is more than a transaction. So when you're in a crypto context, the move of value from a wallet to a different wallet is easy and straightforward. Again, the model is tried and tested in most of the most usual protocols. You can have confidence that that is going to work. When it gets hairy is when you're trying to add all the wrappings that you need for an effective payment transaction to happen. How do you deal with chargebacks, and how do you deal with disputes, and what happens if you need to issue a consumer refund? How do you deal with invoicing? How does the merchant who's accepting a crypto payment integrate that with finance ERPs? Do you need to convince the CFO that they need a separate payment method and a separate payment stack? So the number of layers and products and adjacencies that you need to build on top of the core blockchain functionality is one of the places where you can make it happen or not. Another couple of things that might relate to the use cases that we're talking about and that also we learned the hard way is how do you deal with external data? In our environment, there are many external data sources that you use around payments. Some of them are crypto native, about monitoring criminal activity on the web and making sure that you're not working with fraudulent actors. And there are others that have to do with off-chain data sources and sanctions lists and things like that. You're in an environment where you're tokenizing real estate assets. I would imagine that the value of that token will go up or down with a number of data attributes that are coming from external sources. appraisals and titles and deeds and things that are what are called oracles, so sources of real-world data that need to be fed into the chain for that. And when you're operating in a blockchain environment and you're dealing with a smart contract, for the smart contract, the oracle is the truth, meaning that if you're using appraisal data to assess the value of a tokenized asset, and somebody hacks the appraiser and changes the appraised value, the smart contract will take it as good, and that will impact the value of the asset. So how do you work the plumbing to make sure that those things don't happen and there is data integrity when you're absorbing data from the outside is an important one. And the last one that I would probably say is think about interoperability and fungibility. Nick was likening stablecoins before to tokenized bank liabilities. There is a ton of nuance there. I absolutely agree that stablecoins are one of the killer apps of blockchains, and that many of and not all applications on blockchain will develop their own token, and there's going to be a common language and a few stablecoins that do that. But when you discuss stablecoins, there are probably like 35 camps, but there are at least 2 camps. People who think of stablecoins as store value or e-money in the European version of it, you're saying, hey, this has to be fully backed by fiat, an instrument, and $1 is $1, and you're going to always trade that back to $1, and it's widely available in exchanges, and you can go back to the issuer and redeem. That's one side of it. There is another side of it that's saying, hey, why don't we just tokenize banking deposits? A lot of nuance there. So think of it in terms of, again, interoperability. Deposits are an enumerated activity, so it's very regulated what you can do and not do with a deposit. If all of a sudden you start to have tokenized deposits by 55 different banking institutions, what happens there? Do they trade $1 per dollar? Because then what you have is tokenized commercial bank money, not tokenized cash, which has commercial bank risk. So is a token from bank A worth the same thing as a token from bank B or not? How do you deal with the international aspect of that? If I have a stable coin that is a tokenized deposit from a bank in Germany, is that going to be accepted in the US or not? Do I need to be KYC'd in Germany to do it? So there is a lot of nuance that has to be figured out. I think that tokenized deposits, by the way, are a fantastic instrument and probably very useful to make interbank money movements more effective. Most of the experiences that we have now are in permission environments, not in open blockchains. If you're thinking about open blockchains, that interoperability and fungibility aspect is important. And I would imagine that it will happen the same when we start tokenizing things that are different. If you think of someone like Aave, if I'm bringing collateral to an Aave contract, there is a difference on whether I'm having something that is tokenized cash versus a tokenized deposit versus a standard crypto versus a real estate tokenized asset. If the smart contract needs to execute that collateral and what I own is a token asset, how do I execute that? How do I get that real estate asset? Do I need to go back to the owner of the loan and liquidate it? So all that plumbing and that interoperability aspect is extremely relevant.
Very good. So clearly, interoperability, the plumbing has to be put in place. How do you think about adoption, right? We often talk about where blockchain fits in kind of the housing ecosystem. And, we usually get to a point where, hey, to really make this work, key stakeholders have to buy in. What were some of your experiences there from a payment perspective?
For a long time, there has been a criticism, which I think is a valid criticism, about blockchains that were a solution looking for a problem. And I think that's valid. And there was some of the way of dismissing blockchains who say this is just a glorified distributed database. And in some cases, that is right. There are many good use cases for distributed databases, and they should be used. But I don't think that blockchain is a solution for everything. If you're thinking about adoption, I guess that what we try to do is think of a problem where a blockchain solution is the right tool for the job. And if you abstract back, basically is, can you reduce the cost of contracting between the parties? Because usually what happens, things get centralized because the cost of contracting is really high. And that's the reason that I am employed by PayPal and I have an annual contract and I don't show up in the door every day and I negotiate my wage for a day's work, because that would add too much friction to the process. If you're able to reduce the cost of transacting, then things get decentralized. Think about that when you're thinking about core use cases. This is not about checking the boxes, and many of us are doing proofs of concept and different things in the blockchain space. Free advice would be spend a ton of time on whether the problem you're trying to solve is amenable to be solved by blockchains, because in many cases it will not.
Great. Thank you. Nick, I wanted to come back to a comment you had made about tokenization and the need to be on the chain. Can you talk a little bit more about it? The question I originally had was, hey, if you're going to apply tokenization, do you have to be on the chain? But could you just share some more insights there?
Yeah, I think the benefits of as I said before, the benefits of using a public blockchain come down to primarily settling bearer assets. I know some people don't like that terminology, but if the settlement is truly final, then you get the very nice qualities of blockchains, which I would say are sort of atomicity and composability. If there is an element of if there's a question mark as the finality of the settlement, then you kind of lose a lot of the nice features of blockchains. And so this is sort of having digital bearer asset settlement. This is a fairly novel thing, and I would say that's sort of the true innovation of blockchains, in that you do have payment finality, at least when you're settling a native asset. And having that finality allows you to build up these interlinking infrastructures, right? So in a permissionless way. So that I would really distinguish from sort of how things work in the traditional world or in the banking sector, where you don't have this element of permissionless innovation. I can't go and build a piece of software that references, a commercial bank's database, right? I don't have the ability to peer into that or pull data from it. On public blockchains, things are sort of natively transparent, and so anyone can really reference something built by someone else, and that's where you get all the great innovations. You get these financial products that are built permissionlessly. You also get great risk. I mean, that's where all the hacks come from. Just last night, actually, Jose was talking about oracles. Last night, there was a $100 million hack for a protocol called Mango based on oracle manipulation, in case you guys are wondering about sort of the downside of using blockchains.
Right.
For now.
Yeah, I mean, they're negotiating with the hacker, actually, so maybe they'll get some of the money back. That's kind of
but that goes to some of the transparency, and that's one of the points I wanted to pick up on from Nick, and to think about the use cases, because with the transparency of blockchains, if you've engaged in a transaction, you can show it easily, you can verify it, you don't have to go get your records from a bank, you don't have to go through all sort of the very high friction bureaucratic processes that you're used to. And so I think over time, certainly using your 5 to 7 year time horizon that you gave, in terms of tokenizing payments, it's important to think that we can have on-chain credit scores, other types of verification that we use in the housing market today to get things like mortgages or otherwise to transact in the traditional financial world. And we'll be able to build those out for use cases to allow for hopefully greater participation in the economy generally. And I think that tokenization of off-chain assets, Nick and I were talking right before that, will hopefully allow there to be greater participation in general, right? I don't think we've solved the banking the unbanked problem today, and I think there is still a lot of hope and promise that can come to the fruition. But one of the ways we can do it is by allowing people entry into this new type of economy through off-chain assets they may have if they don't have a bank account or they don't have property and things like that, but they may have other things of value that they can either put in a trust, lock in a vault, and get them tokenized, and then use them in a broader way through this new economy.
Great.
Yeah, I'll just quickly add to that. I think, to sort of sum up the thought, the more remote the asset is from the blockchain context, the harder it is to sort of use it productively in the blockchain. And so if the assets you're using are native, or if they're treated as sort of fungible, like a stablecoin is, then it's easy to transact and build things on it. If the asset is reliant on sort of a third-party entity, and there's a lot of trust involved there, and this active maintenance of sort of the relationship between the asset and the blockchain, then it's harder to build things. Obviously, there's sort of regulatory barriers if you're talking about literal securities, but even assets that aren't securities that sort of reside externally to the blockchain, it's just much harder to actually incorporate that into sort of the permissionless blockchain framework. And so that's the challenge here. And there are interesting sort of new wave, interesting models to take property and try and tokenize it on the blockchain. We are actively investing in this stuff. And we're seeing, a big DeFi protocol called Maker now, they're investing $100 million or $500 million maybe in treasuries, sort of real world assets. So there is a demand for active real world asset yields that are real, as opposed to sort of the fake yields of crypto, right? Real yields based on real economic activity. Yields that have been alleged as fake. But we're not there yet. And so there is a desire to take these sort of third-party, real-world assets and insert them in the blockchain. Still early, even though we've been talking about it for what feels like 10 years now.
So, Kara, question for you. When you kind of look at some of the lessons or insights that you have gained from tokenization of securitized assets, what are some insights you can share that would be applicable in the housing space?
Well, there's definitely lots of lessons learned, and it's easy to get excited, especially talking on a panel like today, to hear Nick talk about some of the exciting things frameworks like Maker are doing and the new use cases for tokenization. In my experience, integrating tokenization and blockchain technology into a pretty established system like the mortgage finance industry and the securitization business that is part of my day-to-day existence. My primary lesson is that taking an incremental approach and establishing proof of concept and generating buy-in from participants is helpful for several different ways. It's easy to focus on the long-term goal and feel like there's a lot of steps to get there, and slowly approaching that long-term goal incrementally over a period of time allows you to not just show proof of concept, but to generate relationships with people that you'll need to ultimately get there. So people see examples of how tokenization can actually improve their business or improve the existing system, and they want to be a part of this innovation. So, for example, last year, Redwood, in its securitization program, was one of the first platforms to integrate blockchain technology into our structured finance reporting. So what had taken about 60 days after a borrower makes a payment to show to investors, we're now able to make that information available essentially the next business day within 30 minutes of being received by our blockchain host. So a borrower makes a payment the next day within 30 minutes of getting the file directly from the servicer. That information is available on-chain to investors for visibility. So just that proof of concept showing that information can be shared to expedite delivery of what we think is impactful information has actually generated a lot of conversations, including one like we're having today, where we can actually point to discrete things that we have been able to achieve and use that to leverage future success.
That's great. So I like the idea of kind of starting with that, proving it out, prove out the concept. How do you think about scaling it from there and kind of building the necessary momentum? Or do you think it builds itself based on the success of a proof of concept?
I'd say it's actually both. After we added blockchain to our securitization platform, a number of parties actually reached out to us saying that they would be great partners to help move us to the next step. So while we continue to frame out in our mind tangible use cases to enhance our business and to continue the discussion with all of our counterparts, we not only are focused on the long term, but also socializing these concepts, talking with loan originators and participants elsewhere in the space, counterparties like investment banks, to see how they might be able to use the expedited delivery of payment information in other ways that would benefit their business and ours, for example, in the warehouse financing space. So it's the beginning of a long-term discussion that continues to evolve over time, because the technology, as Nick was saying, is just continuing to evolve. So we're kind of at the tip of the iceberg, and it's exciting to start the conversation and see how it evolves.
Great. Rebecca, I want to turn back to you. So I know Aave is a key player in the DeFi space.
Yeah.
And when you look at the range of companies that are innovating in this space, can you share some of the applications that you're seeing?
Sure. So as it relates to this panel, I sort of jumped the gun and talked about the centrifuge application, and I think that's really important. And as Nick alluded to very early, there have been attempts over the history of the, as the blockchain spaces emerge, to tokenize certainly mortgages, other types of property, and the like. I think we're seeing some slight resurgence of that, but starting with different types of assets, although there are definitely still new projects who are looking to bring tokenized mortgages and tokenized housing and property and stuff like that back onto the blockchain. I do think one of the things I sort of alluded to earlier, and DeFi, for people who aren't as familiar, refers to decentralized finance. So it is a way of taking familiar economic concepts and automating them through software. So where you'll say something's a lending protocol and you're used to, what a loan looks like, it doesn't look like that when you automate it through software. Same with trading. It's not peer-to-peer. It's all of this interaction through economic activities with software. So you're always interacting with the software. But the building out of the DeFi system does bring all sorts of new financial primitives into it. And we haven't seen a lot of work on real-world assets until probably the last year, would you say, to bring back the resurgence. But DeFi took off so strongly probably in the summer of 2020 and had a lot of interest. And now there's even more institutional interest we're seeing in DeFi. And we do a lot of educating of financial institutions on what decentralized finance means and how the software and technology works, because we think that's really important for sort of broad scale adoption and legitimacy. But one of the things that institutions talk to us about a lot is tokenizing real world assets. How do they bring them on chain? And so I do think we will see, and I don't have a concrete example to give, in terms of what anybody has done to date, but I do think that's where, and your examples are actually really interesting, especially with the proof of concept. But I do think that various financial institutions are experimenting a lot in the DeFi space and will be bringing real-world assets onto this new economic system that we're building.
Great. So, Rebecca, I'm going to come back to you to just build on the answer you just had. So, and I'd actually like each panelist to weigh in on this question. So as we think about the acceleration curve and we think about the opportunities in this space, what are you predicting for the upcoming year? I know there's a lot of attention and focus as we talk about tokenization, and we're also kind of navigating an interesting economic time. Will that put a damper on what we expect next year? But love for you to share your thought and then others to weigh in as well.
Sure. So I'll give a sort of brief answer on that. I think, as you alluded to, the economy in general is going to have a big shift. And while people used to think that crypto were not correlated assets to the economy, I think we've seen over time that there is some correlation, especially for some of the larger assets like Bitcoin and Ethereum and things like that. So I think that we'll see a constriction in the markets we already have, especially post some of the larger crashes over the past summer. But the other thing I think we're going to see over the next year, and this is wearing the other part of my hat because I do all of our policy work too, but I think in the U.S. we are going to see a lot of movement on the policy front as it comes to crypto and blockchain, and hopefully that will bring a lot of security and a lot of clarity, not only for actors in the space, but also for retail users and institutions to continue on with the innovation. So even if we see difficult times in the market, which I think we're all anticipating, I do think that with the regulation and policy coming down in the crypto space, we will see a lot more entrants and a lot more interest and a lot more innovation in building.
Great. Jose?
I agree. I think that there are a couple of things there. Obviously, we're in the middle of a crypto winter. Obviously, the market is risk-off, as most markets are risk-off now, given global uncertainty. For folks who have been around for a while, we have seen this movie before. So this is not the first crypto winter. It will not be the last crypto winter. Same thing that a year and a half ago was not the last crypto summer. So the market is volatile. It's part of the nature of very early stage markets, and we'll see that. I think that what as an industry many of us are focusing in, which I think is a good use of the time, is the technology is getting more resilient. So if you look at, there has been volatility, there have been bankruptcies. If you look at the operating metrics of the more established blockchains, Bitcoin and Ethereum, the protocol continued to work. The hashing capacity, computing power of the network is at historical maximums, and those networks did not skip a bit. So the fundamentals have proven to be resilient. There have been very significant innovations happening now as folks are spending time building as opposed to running around what was the crazy pricing environment of the last year and a half. The merge in Ethereum is a very important aspect, both for sustainability of the network, but also for moving to proof of stake and addressing some of the energy consumption concerns around proof of work protocols. There is fundamental work done at infrastructure level that is happening during this winter. And I want to emphasize what Rebecca was saying in terms of the policy and regulatory aspects. A big development over the last year, especially in the US, is that there is a drive to say, hey, what's going to be the regulatory framework of the space? It's extremely important for the US to get ahead of that for a while. We have been a little bit running behind Europe. The MICA as an effort to provide a harmonized framework for the European Union is a really good effort. It's taking longer. I'm European by born, so I'm not surprised that European Union developments take a while. But it's a really important framework, and it's really good to see that the US is catching up and developing a whole-of-government approach to regulatory clarity. And if you combine regulatory clarity with the enhancements in the base technology, that's one of the things that I continue to be very optimistic about the space.
Thank you. Nick?
Yeah, there's two things I'll point out. So one is the general institutionalization of crypto markets, in particular DeFi. And so there's institutionalization in the sense that large asset managers and financial institutions have finally started to dive into this. BNY Mellon just announced custody for crypto, I think 2 days ago. Fidelity's finally launching a spot product for Bitcoin after, as someone who was at Fidelity, I can tell you they've been working on that for 7-8 years now. And BlackRock is now finally launching products for crypto. So there's that institutionalization, but more interesting to me is taking this anarchic, chaotic environment of DeFi and establishing actual boundaries and creating the ability for regulated entities to actually transact in this space safely and in ways such that they can actually be compliant. And so Anave's been doing good work on this, I would say. But there is an acknowledgement now that DeFi doesn't necessarily mean permissionless. And I know a lot of crypto people wouldn't like me saying that, basically. They think that the whole essence of crypto and DeFi is to be censor resistant, to make transactions you're not meant to make transactions the state doesn't want you to do. But for better or for worse, we're seeing this infrastructure put to work in a way that it allows for permissioning and for knowing your counterparties and knowing what is the liquidity that you're interacting with. And the establishment of those contours will make the environment much more palatable for the insertion of real-world assets. So that's one thing I'm excited about. The other thing is the tokenization of actual physical products. And so if you look at Nike, they've been doing really pioneering work, but it's very much in the luxury space. So Nike, Adidas, D&G, Gucci, LVMH, all of these brands have now begun to insert like actual chips into their merchandise and tie that to NFTs. So basically, the merch becomes inherently linked to the record that lives on the blockchain. And this is exploding in popularity among these established brands. It gives you anti-counterfeiting, it gives you access to secondary markets, and it's kind of flown below the radar. So that is the tokenization of non-securities, of physical products. That's actually a really exciting phenomenon for me.
Provenance for handbags.
Yeah.
All right, and Kara.
I'm excited to go last because I will actually bring the conversation back full circle to the mortgage finance industry that we're all here to talk about. So I'll pick up on a point that Director Thompson made and that I made actually earlier, that technologies like blockchain and tokenization really offer an opportunity to improve the loan origination process for borrowers and in the secondary market. And we saw in 2021 just pretty extreme volume in the mortgage industry and being tied to legacy processes that are manual and redundant and rely on things like paper and FedEx actually became a stumbling block to the ability for traditional finance parties, so TradFi like myself, to actually transact with the efficiency that we wanted. It took longer to originate a loan. It was harder to buy and sell it given all of the inefficiencies in the market. So this the fact that there is, I'm not breaking any news here, lower volume in the mortgage finance industry this year has given parties that are active in integrating this technology the opportunity to socialize, as Rebecca was saying, the use cases for technology and the benefits of technology. Panels like the one Chris has put together yesterday and today help keep the integration of technology front of mind on leaders across the industry. So it's been a great period of time to look at what challenges were faced when there is extreme volume, and then take this pause to continue the education campaign and think about how that technology can help make the process more efficient when it picks up.
Thank you. So that brings us to the end of our panel discussion. I want to thank my panelists, Kara, Nick, Rebecca, and Jose, for the great conversation. Thank you all for sharing your expertise and insights. And with that being said, we're done. So we have a short break until 11:15.
Thank you.
than might be here. But we do that because we have to, because our politicians, and I was one in the Parliament, would demand that we look after people's information, and their data shouldn't be given away, or if it is, it has to be used in a certain way, and the person has to give that, that permission for use. So despite those differences, again, I always look to what's the objective. And there's different tolerance around privacy issues perhaps here than there is in the US, or rather in Europe, and we have to abide by what our legislators have already passed.
Yeah, it really is fascinating. And by the way, I have no idea what the answer is. But when I talk to some of our leaders here, whether or not it be with FinCEN, or if I talk to some of our national security people, you know, it's fascinating because on the one hand, you do have the opportunity for obfuscation, which can lead to abuse of blockchain-based systems, but you also have this radical transparency that can also lead to interesting privacy questions, right? You know, and if you push too far in one direction, you know, you end up with results that can end up endangering people. And it's a fascinating sort of, again, I have no idea what the answer is, so I'm not going to bother you with that particular question. But the question of values and the question of how people interact with one another is something that you brought up earlier, and I think it is especially important. When you look at sort of the immediate next round of decision making, not just in terms of crypto, but you had also started to mention some issues relating to perhaps more or additional open banking regulations. Or like, what do you see your focus sort of in the next 12 to 18 months, and in terms of what your objectives in the sort of financial technology innovation space?
One key one is to the point I raised around retail investment. So we will have a big strategy on retail investment, trying to harness the money that's on deposit that up until recently wasn't earning. So how do we get retail investors confident enough? We want to deepen our capital markets. We will need a lot of money for our green and digital transformation, and this is part of that conversation. That's a key piece of work around the open finance area as well. How do we evolve? On capital markets, we're doing a lot of things to try and make sure we don't have barriers between member states. There's a good bit of work to do around that, including around insolvency. So some of this is quite technical and maybe dull, but really important for us to get strong capital markets. We kind of look here and we think, wow, you have strong capital markets. We have the potential. We rely very heavily on bank financing for our businesses. It's really the opposite here. So we need to see what you're doing, and we're trying to make sure that capital flows across our 27 countries. I mean, the country that I know best, the member state I know best, joined 50 years ago, the common market. It has evolved all of those years now to be the European Union. It's true to say that when it comes to free flow of capital and all that would involve, it's only a work in progress. Which you can either say as, well, that's taking a long time, or as I do, the potential is huge. And I think digitalization will help us in that. So I do think that now is quite an exciting time. A difficult time politically, of course geopolitically, stressful issues around the financial system and energy. But for us in Europe, and I mean this is a key point now, we realise, for example, on the energy piece, that we need to invest rapidly in more renewables. We already had a plan. It has to be accelerated. To do that, you need money. Where do you get money? You get it from some from the banks, some from the public purse, but a lot from the private sector.
You know, that is really something, a nuance I never really thought of until just now, and I think it's useful even for an American audience to think about. You know, when you're talking about that retail investor space and sort of bolstering that space, you're doing it against the backdrop of what the European capital markets or banking markets look like as compared to the United States. And there is this interesting question, particularly in a world of both, you know, more volatile markets and newer kinds of products. You know, how do you deepen your retail space? And I think in the United States, there's still some ambiguity about how retail do we want retail markets to be. But you know, you guys are starting off from, you know, a question of liquidity and depth. I mean, we only have a minute, so, you know, this is pop quiz. You know, any kinds of initial thoughts when you think about retail investors, the kinds of protections that you want to have as you think about deepening those markets?
Without talking about protection, I want people to be aware that there is another way for your money to work for you.
Right.
And that is investing. but I also want them to be aware that it's not a given that you will get a return. So this is about being savvy around money. I think the story of Europe is that during COVID, those who were working, you know, there was a lot of money because people couldn't spend, couldn't do anything. That is actually beginning to flow out. But wouldn't it be fantastic if we could have harnessed all of that towards our future around sustainability? And I think this conversation, you know, is going to grow and grow as people become more aware about pension provision, about education provision. So, I mean, it's a very different starting point than where you are. But some of the newer things like the retail investor, excuse me, on the apps and all of the stories around payment for order flow and these kinds of things. Yeah. I mean, we're watching that very carefully. We've actually proposed a ban on that activity. It's been interesting that I thought that wouldn't get a lot of opposition, but it was striking where the opposition was coming from. And it was coming from younger people, feeding it into the political system. But it's been a good debate so that people understand what these things mean. And if you're okay with them, as long as you understand, then I think you take the risk, but be aware.
Commissioner, it's just been a pleasure. Thank you so much. And for enlightening the audience and certainly enlightening me, I really learned a lot. Thank you for coming down to DC Fintech Week.
My pleasure. Thank you.
Welcome back. So next I am excited to introduce Patrick McHenry and Patrick Collison. Patrick Collison is the co-founder and chief executive officer of Stripe, and Patrick McHenry is the ranking member on the House Financial Services Committee, and obviously two world leaders and world beaters in their own right. So I guess I'll welcome them both to the stage, and I'll have a chair. Come on up, guys. That's pretty nifty chair work. Oh, that's done in our breaks. All right. As I said, I mean, I am just delighted to have you both here, and as well as the people in TV land and wrapped around the corner. You know, to have you both here for DC Fintech Week, the opportunity to talk to both of you about these issues it's a real treat for all of us here in Washington D.C. I guess I will start with
the lesser Patrick.
It's kind of interesting. It's a Patrick, you know, but ranking member Patrick McHenry. You know. We've been talking a lot about innovation and technology over the last couple of days, and we've had obviously most of the administration and really vocal voices from throughout the innovation community speak with us. You know, you have a very unique seat in Congress and a unique voice and a lot of experience when dealing through and thinking through issues of innovation and technology. You know, how, though, has, in your view, that conversation evolved and changed? I mean, certainly when you think about the evolution of new kinds of different financial products, new ideas have been introduced, do you see a change in the conversation? Are there new kinds of questions asked, different kind of tone?
Yes, and I think the conversation's been unmoored from the reality, which is what is the problem we're trying to solve for? What are you trying to enable? And frankly, I mean, what you do at Stripe establishes this, you know, front and center in people's minds. But what we have to do in terms of public policy is make sure that we're talking about the results that we're trying to enable. Financial inclusion is the greatest result of fintech innovation. That's how my father started his business. I'm the youngest of 5 kids. My dad had a buddy down the street who had 5 kids. And they decided that they were going to start a business. So they borrowed a piece of equipment. The second piece of equipment was the truck to put that lawnmower on the back of. And they bought it using the best fintech of its day, which was a MasterCharge.
No.
Right?
Yeah.
And that's what it was then called, MasterCard now, obviously. You do a little bit in this work, but it was my father getting a lawnmower, putting it in the back of a truck that changed 2 families' lives. It didn't change the world, but it changed our lives and put 5 kids through college. Not because we wanted to work in the business, but we were obligated to work in the business, right? But it was enabled by a financial product and access to capital my father wouldn't have otherwise gotten due to our economic situation, relationships, and everything else. So I'm thinking of my father as the innovator and using fintech as the mechanism and all the technological changes in order to enable folks like my dad in what he was able to do to provide for a family. So we need to get back to that conversation about solving problems in the real world in ways that people can understand.
And just for a little bit of clarity, I mean, like, so in your view, it's more detached. Like currently, the conversation on technology and innovation, it's just more detached, and it's not really thinking about the problems of access for capital and for
right. So if you're able to access financial products on an app, it's a huge game changer for the average small business person who worked for themselves. It's a huge change when you bring down the cost of payments. It's a huge change when you bring down the cost to access the capital markets and invest and save. It's a game changer when you have what we think of as digital assets and crypto. Bring innovation and information that is usable to a wide array of people that don't have the relationships to get that information that is opaque and removed today. So we got to go solve for those problems and think in the terms of the average person and their daily lives. That's what I'm trying to communicate.
You'd enjoy the comment that I made earlier where I'd seen literally a politician say that there's never been any good technology since the invention of the ATM, and they had their grandson using Venmo, and I said that probably wasn't the best look for that particular comment. At any rate, I'm trying, too bad, like Patrick Stripe.
Other Patrick.
Other Patrick. Patrick Stripe. Patrick. You've already had a remarkable life, a remarkable career. Built a remarkable company. But even in that short period of time, I would imagine that the conversation on innovation and technology has evolved for you, both in-house over at Stripe, but also in the larger conversation, certainly here in the United States. I mean, from your vantage point, what changes in the tone or in the content or in the prioritization of that conversation have you been able to see, either from your perch at Stripe or just the outward-facing engagement and questions that you receive?
Yeah, well, it's a little bit hard for me to judge because I grew up in Ireland and I only came to the U.S. for college, and so my baseline, I didn't get to kind of establish it through growing up, and U.S. politics post-2016. I presume that's how it's always been, right? So it's an operating assumption. No, so I think the thing that's very striking to me overall is, and building on what the Congressman says, is there's all, for all these problems, you can approach them top down and you can approach them bottom up, kind of conceptually, right? And so with respect to technology or fintech or financial services or innovation or whatever, there's kind of a top down perspective one can have, and you can think about the right ratio of these things and where we want it to go and so forth. But then there's just a very basic bottom up point of view around what is it that's happening, what's not happening, what do we want to enable, what's the consequence at the level of the individual. And the thing that strikes me is, we spend time going around the world, and Stripe operates now in roughly 50 countries, is the US and the European debates tend to be quite top down. And that's not in and of itself necessarily a bad thing. There are lots of phenomena that are only diagnosable and observable in that form. So I'm not saying that it's wrong. But when I spend time in Eastern Europe, or when I spend time in India, or when I spend time in Southeast Asia, et cetera, people are much more indexed on the specifics and the particulars of it is wildly excessively difficult to start an online business, or it's way too complex to sell in multiple countries. In that, obviously we kind of experience this in Ireland, where if you're in the US, you can kind of ignore the rest of the world to some extent. You know, the US is a pretty big place. When you're in Ireland, you can't. And so, you know, folks in Ireland can be very indexed on the challenges and the difficulties and the, you know, all the different considerations around exports and selling across borders. And when we spend time with folks in again, most other parts of the world, these are the kind of salient questions for them. All the silly complexities, you know, sales tax, currency conversion, treasury, how you manage a web of, you know, different entities and so on. And so, yeah, to your question as to, you know, what strikes me about the debate, I think it's we're coming from different kind of ends of the continuum, and I think, you know, probably in every place, you know, the challenge for us is to make sure that both are sufficiently embodied.
You know, it's you know, there is certainly some symmetry here. You know, when you're talking about what you're hearing overseas and what your view is in terms of, you know, what's missing is that overseas, you know, there is a kind of concrete thinking about, you know, what problem are we seeing? So let's work backwards, it sounds like, from what the problem is to come up with a solution. And I guess what you're observing elsewhere is that conversation seems to be a little bit more concrete in terms of how the decision making is going on. Maybe looking at the problem at the bottom and working your way up, as opposed to sort of thinking from the top about potential issues and then working down to the
and Stripe is a very concrete company, you know, in a way that almost makes it hard to talk about, right? You know, one of our products is called Atlas, and it helps businesses incorporate. And like, it's the most unsexy product you could possibly imagine. You know, we're literally helping people file paperwork with the state of Delaware. And, you know, everyone's talking about AI and blockchain.
My God, I love boring. I really love. I'm a law professor.
Well, then you found the right company. But
what's amazing though is in the small business world, it is a massive innovation because you've made it super easy, and you've made it easy for them to figure out how to do it. That's the striking thing to me.
Yeah, no, like, we're always asking these, again, top-down questions as to, you know, how do we foster more innovation across society or whatever. You know, when we survey businesses that incorporate with Atlas, and we ask them the question of, hey, do you think you'd have started your business if Atlas didn't exist? That is to say, if our little form filing service wasn't there, you know, 20–30% of them tell us they wouldn't have otherwise incorporated. And so we think there's a lot of opportunity in boring.
So you know, I think there's enormous opportunity in boring. I mean, my most cited research paper I just wrote, it like blew away everything else, was how do you incorporate a DAO, basically a decentralized autonomous organization.
Good piece of work.
I mean, oh yeah, well, thank you very much. I mean, like, within 2 days had blown away anything, which made me both happy and sad at the same time about my career. But, like, you know, it's a very boring and basic question, like, how do you incorporate it? I don't know. You know, I guess I'll you know, I'll go from the boring to the exciting. I'll just ask you that question. You know, obviously you spend so much time in payments and thinking about payments and really making that payments experience more effective and efficient and safer and everything. You know, are there any developments that you're seeing nationally, I mean, here in the U.S., internationally, that you find to be particularly interesting and exciting? And you know, is there something that the government, wherever that's happening, is there something that they're doing to help enable it?
Yeah. So as a first-order matter, I guess, you know, we think a lot about how you know, we're in a world of, you know, 7+ billion people, and most of those people do not have access, you know, they're not in developed countries or, you know, fully emerged markets, and from a financial services standpoint, they don't have access to all the things that, you know, we ourselves get to benefit from. And so we, you know, the question that we're preoccupied with is how do we provide some kind of, you know, global unity and integration so that people, I mean, the promise of the internet is, you know, the old New Yorker cartoon about, you know, people on the internet don't know you're a dog, you know, and so people on the internet don't know that you're a dog, and they don't know, like, the political identity of the specific atoms, you know, you happen to be sitting on top of. You know, that's what it represents. But of course, once the movement of money gets involved, then national boundaries and borders tend to become kind of primary and salient and inhibitory to lots of activity. So we're thinking about how do we surmount some of that. And there are lots of specific technologies that we think are compelling and exciting, and where policymakers are doing cool things. PSD2, open banking, faster payments in the UK, FedNow here in the US, hopefully next year, and all that's good stuff. Again, it's not necessarily focal and central in the limelight, but I think it represents major advancement and opportunity. And in emerging markets in places like Nigeria and India and Brazil and elsewhere, there've been kind of new central bank-based real-time payment systems, for consumers that have seen tremendous traction and adoption. And then, we think there are cool opportunities in crypto, where I suppose you can kind of look at crypto in two ways, and sometimes I think the former can kind of occlude the latter, where on the one hand you can look at crypto as this kind of casino, gambling, speculation, all that stuff, and assuredly there is a significant amount of that, but it also represents and harbors the possibility of being a much more participatory and kind of inclusive and open access transport layer and rail for sort of financial inclusion on a global basis. We launched a thing that we're quite excited about with Twitter back a couple of months ago, where they're enabling creator payouts to a much broader watershed of people than they would otherwise be able to address. And I think there are, of course, people here in DC, like again the congressman, who I think have been very cogent voices in trying to make sure we don't miss that ladder while addressing the complexities and challenges of the more speculative use cases.
It's fascinating. I just to that theme, I find that sometimes it's very easy to miss that there is a technology stack, whether or not you like it, dislike it, but to really kick the tires and to think about what that can enable. And that was a wonderful hand baton to you, Congressman. I mean, you've been truly at the heart of many of the most important conversations in crypto world, and including stablecoins. And I know that you and Chair Waters have been in a series of conversations on stablecoins and whether or not, or what any particular regulatory regime should look like. Maybe can you give us a little bit of a little sneak peek, a little bit of detail as to where those conversations may be heading?
So I think just starting in reverse here, we have to understand there is currently no federal regulation or description of a digital asset or the means of exchange or any regulation or law around what purports to be a stablecoin. So we have something in the marketplace that says it's a U.S. dollar, but there is no form to it. The only regulation there is in existing law around the movement of digital assets is money transmission licenses that are issued through the 50 states. So that doesn't look like a modern regulatory regime. It doesn't look thoughtful. It doesn't look innovative. It actually looks pretty retrograde. So let's deconstruct that. You have to have a means of exchange and a definition of a digital asset. A means of exchange and a definition of a digital asset will be the work of the Financial Services Committee next year. In the meantime, Chairwoman Waters and I have been in long discussions and deep discussions around how we have a federal regulatory structure for stablecoins. We agree on the asset, that is narrowly defined set of assets, one-to-one backing, no leverage. We agree on all the components of what the asset is. Then we get into more complex conversations. Well, what is the means by which you hold it? The regulation around what is a wallet, because we don't have regulation around either of those two things. And then who's your federal regulator? And that too is less science and more art. And then we also have to have the administration involved in this, not just Chairwoman Waters and I negotiating the House, but we brought in the Treasury Department. And so then there are a number of trade-offs in a bipartisan compromise, and so we've come up with a pretty ugly baby. It is a baby nonetheless, and we're grateful and hopeful that this ugly baby can grow and prosper into something that is a little more attractive. So that's where we are, and I'm hopeful along the way. Look, I say this with pride, with a smile on my face. You're acting as if
the proud father.
Yes, yes. And so, That's what we're trying to do.
I felt a lot of my biography there.
Yes.
Until you said it got more attractive.
Well, I think that's the reason why we're both named Patrick. So that's what we've done, and we've come up with something in an election year, in a divided Washington, in a divided, broken set of politics that I think is a sign of hope that we can have complex, difficult policy making in the midst of all this chaos. So I'm hopeful what this means in the coming months. I'm optimistic that we can come to terms, and I appreciate the trade-offs that my Democrat counterparts have been willing to make so that we can actually have a bipartisan piece of legislation.
I mean that the bipartisanship that I've seen and displayed, I'm trying to think of some kind of analogy that could possibly beat ugly baby, but instead I'm just saying, the meat gets done.
But I'm hopeful about this baby, though.
You're hopeful about the baby.
I am.
Okay. But I guess we'll then shift a little bit to the sort of economic questions. Okay, well, okay.
I like your live question.
Yeah, I know. It's hard.
Subtweet us.
Right, exactly. Okay,
can we like reply? Like
yeah.
Elon style.
Yeah. This is true. It's like, let me just tweet my response. Okay, I will. Just because someone had said this, and I was. Okay, well, one interesting question that we're already getting from our audience is, what are any major differences that you're seeing between the U.S. and EU or Euro fintech innovation similarities? And by the way, I love it because it's addressed to Stripe Patrick.
The EU, maybe two things. So one, the EU has, well, generally speaking, and by certainly stereotype and archetype, Europe is somewhat more regulated, somewhat less free market, et cetera, et cetera. And then you get these interesting exceptions to this, right? When I came to the US, trying to understand your sports, it's there are these kind of little tightly regulated socialists, sort of capped and
what?
No, because like
it's so true. Yeah,
there's the pay caps and you're trying to make sure that no team ever like.
Is it American football? You're talking about American football or basketball?
I mean, all of them. They seem.
Oh my God! Okay. I'm not.
They all blur together.
I'm just a moderator.
So whereas in soccer you have a very there's players can be paid whatever you want and
Oh! I think in terms of the rules. I'm like, are you kidding?
No, I mean there's economics around it. Yeah. But like soccer in Europe or football as it is called, it's much less kind of economically restricted. And then with cellular technology, kind of similarly, and airlines, there was kind of significant structures were put in place that enabled a much more competitive market than existed sort of at the time in the U.S. And the thing that's interesting in and even if you look at the EU, like on the one hand, the EU is a regulatory administrative edifice, but it's a regulatory administrative edifice that is in many cases in service of, and certainly was originally in service of, creating broader, larger, more competitive, more open markets. So I think it's kind of a very interesting you can kind of look at it in both ways. And so with respect to fintech in particular, the e-money licensing regime in the EU, which is kind of something between the sort of money transmission regime that the Congressman just mentioned, and kind of full-on banking regulation, on the one hand, that is it's a regulatory construct. It's a new way to be regulated, but it's a new way to be regulated that has unleashed an enormous amount of consumer financial services innovation in Europe. And so, banks like Revolut, N26, Monzo, et cetera, there's tons of this stuff happening, and there has been for years. And, the EU is really a center and a hub for fintech. So that's one. And then two, kind of like some of the GSM stuff, directives and regulations like PSD2, like some of the new rules and kind of standardization around open banking and SEPA and real-time SEPA and so forth. Those are, I think, creating very compelling new opportunities in the free market and kind of in this broader fintech landscape. And so, it's hard to. Well, it's not a kind of national competition or a regional competition because these companies generally serve. I mean, Stripe itself is dual headquartered in the U.S. and North America. But if you're to like really zoom out and just kind of ask which region has been a more kind of successful hub for innovation. I think for technology overall, you would have to say the U.S. to date. I mean, just look down the list of companies. But for fintech in particular, I think Europe is every bit as strong, and at least arguably has kind of pulled ahead. And I largely attribute it and credit it to these kind of underlying structural differences.
So how do we improve that in the United States? As a policymaker, I'm desperate to ask this question.
Please,
Sorry, Chris,
please.
to interrupt.
No.
You got me hooked, so I want to know.
Yeah. Well, I think the clarity that you're like the point you're making with respect to crypto, where it is. There's such a a vast penumbra of uncertainty around where this goes, and I think for rational actors then trying to make investment or kind of allocative or any kind of decision in the face of that, it sort of very understandably gives them meaningful hesitation. And so I think where there is uncertainty, bringing clarity makes a great deal of sense. And then it's an interesting tension where on the one hand I think I don't know. I just got here, so I don't mean to.
Regulatory clarity, though, I hear that.
Although it is interesting, and I didn't want to put Mary McGinnis on the spot here, but the crypto.
Actually, can we bring her back?
Yeah, we can bring her back. I mean, she was actually really, really good at this.
Yes.
But it is fascinating. Like. The European Union is not always credited as the speediest institution for rulemaking, and for years the United States politicians and leaders in government would go to the EU and go to Brussels, and they'd make the question of, I'm here, I have a problem, I don't know whom to call, right? And I do find it fascinating that when you come to the United States now, particularly in some issue areas, but certainly when you get to crypto, the Europeans are asking that same question, right? And then sometimes the answer from the United States is, well, we're not sure, but we'll get back to you in just a second. And I think that does create a very interesting process.
But we're in a new world in the United States. We had, since World War II, this belief that we have a moat. We have no moat. Our capital markets, there's competition for our capital markets and in corporate issuances globally. There's a choice set of where you deploy innovation. As you're showing around the globe, the things that you can do in other regimes that you can't do here in the United States are quite significant for Stripe. And so we have to be, American policymakers, on a bipartisan basis, have to understand that we're in a competitive world, and we've got to be better versions of ourselves. That means we have to have rule of law, speech rights, property rights built in to what we're doing, and be able to ensure that people seek the United States and have that de facto what gets exported, which are our values. And I mean, not the values we debate, the values that we don't debate, which is you have a right to your own property without government seizure, right? You have a right to free speech. Those things that should be embodied in everything that we're about as a society, so that we can argue about everything else, right? And the beauty of our system is that with competition, the best solutions come about. The government doesn't bless it. The government doesn't choose it. It's the people that get to choose it in this competitive atmosphere. That if we're really good as government policymakers, we get the best outcome for as many people as possible, which should be a shared goal. Regardless of your ideological view, that should be our shared goal.
This is totally not the conversation I thought we were going to have, but an excellent one, an excellent one. And our time is up, but gentlemen, I so appreciate this. I've learned so much already just through the course of the day. Excellent conversation, and thanks for joining DC Fintech. Good to see you. All right?
Thanks for having us.
Hey. All right. We're going to have our next big finale before we get to our drinks and networking and the like. In which we also have some great leaders from Congress, Khanna. We're having also Sharon Bowen, who is the chair of the board of directors for New York Stock Exchange, and Gene Ludwig, the former former comptroller of the currency, and who's now the managing partner of Canopy. And we will be joining you shortly, apparently. Oh, no, they're here. Okay, come on the stage. On stage for all three of you. Wonderful. Thank you. Long day. Please. Okay, we are at our wonderful finale. We've had over the course of the last couple of days, basically all the leaders from government, TV land, from all the different networks and C-SPAN and the like, broadcasting our series of conversations on innovation and democratizing information for the American public. And when I think about this, I've had versions of this conversation with each of you three, and that's why I had to, starting off with Khanna, Congressman Khanna, to say, please come, please come. You gotta come. I know you're only in California, and thank you so much for making it down. I want to just have a conversation that I think is really important, again, for all the journalists to sort of think through when you have this conversation on, trade-offs to innovation and technology. And something that you and I have talked about is that we've had and we've seen plenty of conversations on innovation, but innovation isn't necessarily opportunity. How do you go about connecting the dots on those two, both philosophically and also as a matter of policy?
Well, Chris, first of all, thank you for inviting me. An honor to be on this panel. Look, I have a district that has produced extraordinary innovation. Apple, Google, Intel, Yahoo, Cisco, LinkedIn, Tesla, all in my district. $10 trillion of market value, probably the most wealth that's been produced anywhere in one region in human history. But the challenge is everyone benefiting to be productive in a society that is innovating? And a lot of the opportunities of wealth generation have been concentrated based on place, have been exclusive of people in rural communities, in the heartland, in the South, of Black and Latino communities. So the access to wealth generation of a modern economy have been limited. And then the second thing is we offshored, in my view, incorrectly, too much of our production and did not factor in the innovation of production that made America an economic power. And that led to the decline of a lot of blue-collar jobs in this country.
Yeah. I mean, it is interesting because even over in earlier iterations during the pandemic when we had to have this conference virtually, there's been an observation even internationally that there's been an assumption that there would be, let's call, trickle-down opportunity or innovation, that if you can just generate it, that naturally would flow to the rest of the country. And what you've observed, both in your writing and what others overseas have observed, is that a lot of the benefits of that innovation that are being used and made or produced either only in Silicon Valley or in other parts of the country, and sort of making sure that that again, innovation translates to opportunity is a process. Just to follow up really quickly, do you find that is a policy kind of process to enable that opportunity, or is this a market-driven kind of process in which you have to reorient sort of different nooks and crannies of our markets?
I look forward to hearing from the others as well. But look, Thomas Piketty has researched, whatever you think of his ideology, that shows that the middle class and working class in America since 1980 have lost 25% of wealth. That's factual. This is why most people in America feel that the American dream has been downsized. Those were policy choices we made. We chose unfettered market economies with globalization. We said, let things go to the cheapest labor. People can go move. People will find the opportunity. We'll just train them. And it didn't work. It didn't work for many factory towns in America. It didn't work for both the white and black working class. Bill Spriggs has a paper that the biggest victims of deindustrialization were actually the African-American community that have lost millions of jobs because of that in places like Dayton and Chicago and Milwaukee. And, of course, that it's happened in white working classes. And they didn't go and have new economic opportunities. So I believe that it was a failure of an exaggeration of the benefits of globalization. I'm not saying that there weren't positives to globalization. Millions of people came out of poverty. But it has to be, but there was not a focus on place. And we need to reconsider some of those policies.
Sharon Bowen, You are a trailblazer in so many different ways, and now you're sitting up as chair of the New York Stock Exchange, which is in and of itself. The stock exchange is a very fascinating entity, a very critical component of the financial system. But for you, where do stock exchanges sit in this larger question of innovation, and is there even an element as to how they touch on questions of opportunity?
Well, first, Chris, thank you so much. You've done a great job for this conference, and can't believe we're the last panel. So congratulations.
Thanks.
And the success that you've done. I'm delighted to be here with Gene and Bo as well. So believe it or not, the stock exchange really sits right at the intersection of innovation and opportunity. When you think about, we raise capital. Capital raising is important for job creation and for growth in our economy. And more importantly, the stock exchange brings transparency, technology, and data for us to have fair and orderly, efficient markets. At the New York Stock Exchange, I said I would use my platform especially to help our 2,400 listed companies who are at various stages along their ESG journeys, which is really important, not just to shareholders, but to other major stakeholders. So when you talk about innovation and opportunity, I think about one of the services we provide to our companies especially are like tools that are focused on ESG, forming things like our board advisory council to increase diversity on boards, things like a sustainability council, again, to share best practices. So I think our platform is a great one for companies to share best practices. And we know, again, capital is the engine that grows the economy.
Well, from the West Coast to the East Coast, and now to Eugene, your background is also extraordinarily interesting as a former comptroller and now an investor and someone who's been very passionate about the wealth divide and the digital divide. It's something that you've seen up close. Now, as you've sort of seen the landscape, as you continue to even advise folks informally that I know, how do you look at which technologies seem to be very interesting to you when it comes to attacking particularly that pain point of financial innovation or financial literacy, access to capital? Are there things that kind of interest you more than others? And after all, we are, here in the belly of Fannie Mae, if there's anything that interests you in terms of housing.
Yeah. Well, let me first say, as my fellow panelists have said, this is really a remarkable achievement on your part, Chris. And it's an honor to be on the panel with Ro and Sharon, who are icons in terms of what they're doing in life. So, and particularly for this panel. I'll give you an example of what excites us. So at Canopy, which is the venture capital fund that we have, we invested in an outfit called Nova Credit. Now, what does Nova Credit do? They have been able to hook together data from the world such that when an immigrant comes here by way of asylum or whatever, he or she has information that can be used in a credit decision, because otherwise somebody comes here and they don't have a credit history that a lender can access, and they either get way high or they can't get credit at all. This allows them within a reasonable period of time to get credit at fair prices so that they can live a decent life here to start out with. It is innovative technology. Interesting enough, the fellow who founded it started out with this idea when he was in school, and he's done a great job. That's the kind of thing that really gets us up in the morning. And the reason these investments and the kind of thing we look for are important is that if you can drive down the cost of small dollar transactions and or differentiate through the use of data between people that are credit worthy and who are not. And by the way, that means expanding the credit box. There are loads of people who, by today's standards, are viewed as not credit worthy. In fact, that's all wrong. And so if you can do that through technology in our huge global society, that really moves the needle. And that's what gets us up in the morning.
Yeah, you know, one conversation that we had earlier this morning was with Director Sandra Thompson, who is the FHFA director. And just to your point, you know, here we've worked very hard to include rental data as one of the sort of drivers, you know, some of the data to harvest for determining credit decisions, because, you know, there's a chicken and egg problem. Like, you have to own a house in order to get credit, you know, and people generally don't want to lose their home or their dwelling, at least. And we should be able to harvest or capture that data for the purposes of opening the credit box, and that's been something that we've really been thinking about, and I think data is really becoming very critical. I'm going to move right back through the group, but I did want to touch base with you on the macroeconomy, given your experience as a regulator, and now looking at innovation. Earlier yesterday, we were talking about sort of crypto winter, but we're also talking about really a winter for all of our markets, including our stock markets. You know, when you think about that innovation to opportunity pipeline, right? What does a slowing economy mean, right, for the development and for, you know, enabling that particular pipeline?
Well, here's what really worries me a lot. And I want to associate myself with Rose's work and Rose's concerns, as well as Sharon's. With a slowing economy, and I think we are headed for a recession, one finds that in low and moderate income communities, poor people get fired first and rehired last. And the benefits of innovation they don't get to you know, really enjoy, because we're just at the beginning stages of innovation in financial technology. But with this profound situation where they get fired first and rehired last, what happens is that their house prices drop like a stone, because you have in the regulatory mechanism you have something called mark-to-market accounting. Basically, it values a property at a point in time. Now, if you had to sell any of our properties, or your property, or anybody else's property at a point in time in the worst part of the recession, they would go down. But if you're somebody who's lost their job, it goes down even further. And that volatility means that the financial institution, whether it's a CDFI or a minority bank, you have to take a loss. And then they get beat up. And so what we destroy is a wealth generation mechanism that is so important in terms of housing, and also the utilization of these institutions that so desperately need modern technologies, because they're on their back foot. And what we've got to do as a society is put a floor under our communities in low and moderate income areas to get them through events which are typically not in any way caused by them. They're bycatch. That was true in 2007, and we did a better job in 2020, I've got to say, in terms of helping. But we've got to do that, and it's profoundly important.
You know, I love that you also, you know, brought up, you know, the minority banks and what the slowdown means in terms of the creation and access to capital and investments. And again, we'll see spillovers there. And just as a quick remark, as I talked to a former commissioner over at the CFTC, and something that we've talked about, may have mentioned it to you, I know I've mentioned it to Ro, is that when that slowdown happens, you know, what are the tools in the toolbox for the regulatory agencies? And most regulatory agencies, OCC is a little bit different because of the Community Reinvestment Act. Most regulatory agencies don't have a financial inclusion mandate. So just in terms of that responsiveness, you know, what are the tools that they have and the flexibility that they have to respond if you're not either an FHFA or OCC? And, you know, for me, I'm always a little nervous, and we'll see.
Well, this is a really big topic and a really big set of questions, because at our LISEP, our Institute for Shared Economic Prosperity, we've been studying the economy generally, and we've been quite worried about these downturn situations. And the regulators have got to realize, when they're dealing with vulnerable communities and smaller institutions, that the regulatory mechanism has to accommodate to those institutions, as opposed to applying to them rigid standards that may work with the huge institutions, but don't work with these smaller institutions. Again, they're bycatch. They didn't cause the problem. And I can go on, and I won't.
Yeah.
We want to.
I don't usually root for these things, but I do care passionately about these things and getting right answers. And I know, Sharon, you and I, and you've been very, very vocal before, about what's the toolbox, right? To make sure that our rules are really responsive to communities. On one hand, it's a question of, well, is there even a mandate within our agencies to think about these communities? Another question is there personnel in place that is familiar with those communities, either in the private sector or in the regulatory sector? You're now sitting really at the intersection of finance, right? In your role over as the chair of the NYSE. I mean, how are you now, as you've transitioned into, the Geppetto of the global markets? How do you think about those kinds of issues?
So I take those really seriously, as you know, Chris. First, a couple of things. I won't even talk about the direction of the market because I'm not an economist, so state that up front. But I do know, what happens during financial crisis. Having been as civic as vice chair and acting chair, and witnessing people lose their jobs, lose their savings accounts, those devastating effects. And frankly, like everybody else in this room, watching the impact of COVID and the pandemic disproportionately affecting the Black and brown and underrepresented communities. And so one of the things I'm most excited about, because I'm always an optimistic person, I was just at Treasury last week at the Freedmen's Forum, which was the first.
Yes, of course.
Yes, in BFI. And one of the announcements was about the Economic Opportunity Coalition, which is a partnership, with private industries and foundations to bring money into the community financial services institutions that we're talking about. They committed $1 billion to not just to throw money at it, but also to make sure that deposits are put into these institutions. And more importantly, to address some of the barriers that are there, technology being one of them, being up to date and current and sharing platforms with data collection and information. The other, frankly, is a talent shortage. And companies are now committing that we're going to do secondments. We have our talent, Silicon Valley and others, to provide those resources. But we have to jet fuel this. We've got to think big. It's not going to happen incrementally, and you know it. I mean, it's just not, nor will it happen organically. And so, I'm a big believer in public-private partnerships to work together on this. And I think we all pretty much align in that respect. But we definitely need to supercharge it.
So Professor Khanna, and I'm intentionally calling him professor because his book was extremely well written, and one day I'll sucker him into teaching a class with me one day. But when you think about
you're the one who has tenure. I never.
We can work this out. We can work this out. When you think about, again, this question of macroeconomic development, where you have a slowing economy, you have much higher interest rates than before. Your book was written sort of in the opposite context, right? Where Silicon Valley is doing really well, the technology sector is going kind of gangbusters, and you're thinking big, you're thinking ambitiously about what can be done in a particular economic context, or that's the question. When you were writing the book and thinking about democratizing opportunity, to what degree does an economic slowdown impact the ability to continue that process or to accelerate it? Not necessarily from a GDP standpoint, but from literally that pipeline from innovation to opportunity. What do macroeconomics mean?
I think it makes it more urgent. If I could just say very briefly, when you were talking about the startup on immigrant credit, it brought back a flashback when my parents were immigrants from India, and I grew up here, born here in Philadelphia. But when we had a cousin or something come, I used to remember my parents used to take them to Sears or someplace to shop to get the credit card because they had no credit to build up credit by getting those cards from stores. So it'll be a big innovation to move forward. You know, I don't think we have to reinvent the wheel. The model of what builds a strong economy was Hamilton and FDR, where they basically, when FDR built our modern industry, and it was through federal financing, it was through government purchasing, it was through working with the private sector, and we had tremendous industry. Now, it was exclusive of largely the Black South, because the New Deal was not an inclusive policy. But what we should, I call it a new economic patriotism. We realized in the pandemic, we don't make masks here. We don't make enough baby formula here. We don't make batteries here. We don't make semiconductors here. Why don't we supercharge the production of the modern economy and do it across geographies and have the federal government partner with the private sector and HBCUs and land-grant institutions? That policy is good in a recession, and it's good, frankly, even on inflation to produce more goods in the United States. So nothing I'm saying is original. It's sort of the framework that built the American economy, except I think now it should be more inclusive to have everyone on the playing field, where that wasn't the case in the past.
I would just add in that respect, you do need to have a different landscape, though. You do need to bring women and minorities to the table. Well, those guys did a pretty good job, you know, creating the financial system, but to really be inclusive, and we've spoken about this. If you don't have people at the table making policies, thinking about what affects their communities, we may wind up with some bad choices. Just because we didn't have the right people.
That was women were in the factories in the World War II. Yeah. Women built the industry of the country.
I'm not saying you were trying to exclude women. I'm just saying.
What you're saying is just very profound. When you take a tool, we may have to raise interest rates the way we're doing. But on the other hand, this is chemotherapy, and it's a chemotherapy that falls hardest on middle and low-income Americans. It's easy to say, well, you raise interest rates. People can pay higher interest rates, but if you're at the bottom of the thing, this is a profound change in how you budget for yourself, and it falls disproportionately on Black Americans, on Hispanic Americans, and in low and moderate income communities, and on technology, because what happens is you see it in the markets, right? The technology stocks have dropped the most, so that innovative oomph is hit hard, and it's not good for the country. Now, we may have to do it, but hopefully over time we will develop more creative, you might say, targeted medicines that can deal with the problem without killing it.
Well, one of the reasons why I every year kind of do this event in this forum is, because and thankfully we have a lot of press now who sort of cover it, is to just sort of introduce new kinds of conversations into the dialogue, because I think that there's a way to go in media as well as everywhere else, and there are conversations, important conversations, that aren't always being captured. One of those conversations that I just find fascinating is the conversation on even investing and retail investing, the standard sort of line. And, we had Mary McGinnis here, and she had noted that because of the reliance in Europe on banks, one of her goals was to increase the size of the capital markets. So she wanted to encourage investing and retail investing in the European Union, because she's looking at the other side of the pond, and she's looked at us and said, well, look, you guys have the New York Stock Exchange, you have NASDAQ, you have these exchanges, and so we want to be more competitive. Now, one of the responses intellectually, I wasn't going to, just drag up all our issues for the commissioner, but one of the interesting things that I thought about was the challenge in terms of how sometimes the conversation on retail investing kind of takes place, because what technology is doing, for better and for worse, is increasing the participation of younger people in the market. And I think it's requiring a kind of a rethinking of sort of fundamental assumptions about our markets. But ultimately, if you think that owning a home is the first rung on a ladder to building wealth, usually for most Americans, investing, whether or not be on in your retirement account or something, is how you climb up that particular ladder. But thinking about how to enable that and how to do it safely in a world where there's a lot of volatility, that's kind of hard. How, Gene, I'll just start with you and I'll just go through, how do you think about that challenge? Because if you don't have investment, if you don't have participation, you're going to have, continuing stress.
Well, you're so profoundly right, Chris. Owning your own home is a cornerstone of people's well-being and actual savings over time. Having said that, this is an illiquid investment, and you're not going to want to move out of your home until you're quite aged, so you can't get the money out. Your family may. So you've got to have something else. So investing, saving, very important. For low and moderate income people today, you still, in terms of doing this safely, want to go to an insured institution like a bank, because there are a lot of choices you can make, but for people with very little savings, they're not going to get the advice that Bill Gates gets. Modern technology with a lot of the modern tools that can enable individuals, but also financial institutions like banks, to be able to provide more successful outcomes for them, give them a little bit of spread, and there are a number of them out there, are really changing the marketplace so that one can give better investment outcomes for smaller dollar amounts. That's the profound value of this innovation we're living through. It's using technology to be able to deal with smaller units in a cost-effective way, which allows people with less savings, less assets, to be treated better, whether it's in lending or investing, than they otherwise would be treated.
Sharon?
Well, you need to have the money to put into an account, number one. So
true.
Getting a job, a good paying job is the first step. But we do know, though, Chris, that the home ownership rates for African Americans has gone down, not up. We know that the cost of borrowing for people like African Americans is higher than it is for white Americans, even with the same credit profile. So we have a lot of systemic barriers that have been there to begin with that goes beyond just, the data won't solve for some of this. It will shed a light on it, which is really great, as well. But I just think we have to kind of, not just shine a light on things, but we have to be really intentional and be very specific to really move the needle in this, because I just don't see the policy making doing it by itself. The private sector can't do it by itself. I think we all have to be kind of in the same boat together, wanting this to happen.
Well, we do have one interesting question coming in for Representative Khanna. You serve one of the most tech-forward U.S. districts. It is also has one of the most expensive housing markets. Is it possible for local startup partnerships to help get more people into homes, or any other kind of partnerships to solve sort of more challenging pain points given the economy?
Sure, but I think I mean, startups getting more homes is good, but I think we need more fundamental policy reform. I mean, Freddie Mac and Fannie Mae's building, so one of the things I'll say, and we're working on a bill, is I think Freddie Mac and Fannie Mae need to be banned from providing low-interest loans to private equity that is going up and buying homes worth under $500,000 and holding them and letting them sit vacant. I mean, we weren't born in this country to be serfs to Wall Street. And that's really what's happening. Now, it was allowed after 2008 because property value was depressed. But now you're basically enriching these private equities and you're creating artificial demand. And at the same time, you have constrained supply because of NIMBYism. And so we need to make sure that we're building housing so that, the aesthetics in my district shouldn't matter as much as having teachers or the working class be able to live there. I can say that being in Congress. It'd be very hard for me to say that running for city council in some of the places that I represent. So, I think that the failure of housing in my district is a failure of policy.
I agree, by the way, about being intentional, and I think you're absolutely right on the policy. One thing, I'll scoop myself. Tomorrow I'm going to announce that an activist group event in Atlanta, that we're going to give a reasonable amount of money to for an entity to make loans in low and moderate income areas at 3%. 3%, and I don't expect any of the money back. This is an experiment. Okay, can you use the mechanism that we've set up to make safe loans at 3%? Because if you can show that, in fact, that can be done on a cost-effective basis, then what can happen is you can basically expand this program nationally. Because I think if you look at this is a version for the United States, what Muhammad Yunus did so brilliantly in Bangladesh and the rest of the world. But we've got to have that innovation. We've got to dedicate technology to basically give us the tools to help in this area, because you're absolutely right, Sharon, what you said. You know, black Americans and low and moderate income Americans generally are profoundly disadvantaged by the current system. And as you said, Ro, things have been going down for 20, 30 years. At LISIP, we've got all the data to prove that, and all the intricacies, because we've got headline statistics that make no sense in terms of measuring the real economy. So this is an important moment in history.
So, Gene, we just need to multiply that hundreds of times. But that's the kind of partnership that I'm talking about. And we can definitely, with data and technology, reduce the friction and the cost of borrowing and the other barriers that have been there.
Okay, so my last question, just based off of this, like, I mean, because you've just you're scooped yourself, and it's very, very interesting. But like, I mean, how optimistic? You know, these times they're challenging. People are hurting. There are lots of changes. But you know, when you think about, again, the technology and the innovation and the question of opportunity, I mean, you know, how optimistic or cranky are you when thinking about, you know, getting to where we need to be? And I'll start with Eugene, and then.
Well, you couldn't be in the venture capital business, or in business generally, odd for a former regulator, to not be a glass is half full person, right? You've got to, right? You wouldn't be
a lawyer too.
And a lawyer too. You've got to do that. But no, I think we're at a flexion point worldwide as we begin to understand a dramatically different technological and global environment than the one we had 50 years ago, even 50 years ago, let alone 100 years ago. And if we continue to have a controlled market economy, and you might say a public-private environment that is, you know, really trying to reach out to do good for humanity, I think we get through this period in better shape than we found it. But we're at a flexion point, a difficult people are confused. There are people being taken advantage of, and we've got to basically join hands to push forward. And that's what I love about venture capital in this area, because the hope for the future is in part in the innovation we're developing, and then it's got to be important in shared outcomes. That's why I'm created this shared economic prosperity, where we have great outcomes like we're seeing in Silicon Valley, but these benefits are shared more broadly for the entire population.
I'm always optimistic, Chris.
You are.
You know that.
You are always optimistic.
I'm always optimistic, and I do see the silver lining. But for many reasons. I mean, we look back over the last couple of years, there's some things about that genie you're not going to be putting back in the bottle in terms of disparity, and also I think the earnest efforts of corporations who wanted to do good and wanted to be good corporate citizens. I think we just have to harness that, again, in a specific kind of way, multiplying the kinds of things that Gene's doing. I think it's really important. So I'm an optimist, for sure.
I'm hopeful as well. Partly it comes from my story. I mean, I was the son of immigrants born in Philadelphia, and at the age of 40, the country elected me to represent one of the most innovative places in the world, and we're all a product of our story. But also what gives me hope is a lot of the young folks. I mean, both the folks who are marching for climate around the nation, the people who are organizing at places like Starbucks and Amazon. The workers' rights movement has never been stronger in my lifetime. And then I was actually in New York meeting with a number of folks in their 30s and 40s, and they said, "Ro, you don't have to be sheepish about talking about the union movement here or your work on climate. There are a lot of folks in their 30s and 40s in Wall Street who believe in a lot of these issues, and they're going to be in charge soon." And so I think that there is a moment for this country to correct the excesses of globalization and the exclusions of our past. And what we're trying to do has never been done in the history of the world. There's never been a truly multiracial, multi-ethnic democracy. And so I'm hopeful that our generation will help move it there. And certainly our challenges are far less than people like Jim Clyburn or my late colleague John Lewis, who had much more daunting challenges than we have.
Well, thank you so much to all three of you. I mean, this has been a special afternoon for me because I've had the opportunity to talk to so many of my role models and people who I admire and aspire to emulate my own behavior. And I want to thank you all for joining us. And this also wraps up the marathon known as DC Fintech Week. I will subsequently go and pass out. Thank you to everyone, Videoland, Internets, as well as people here who have supported us. I want to have a special thanks to Camilla, who I cannot emphasize enough. Weekends, literally 3 o'clock in the morning, do we have enough lunch boxes? And, I will get a response within 3 minutes. It is hard to emphasize how much work Zainab Ahmed and also Mariano. There you are in the corners. You guys are troopers. I mean, the kinds of people, Kristen, others, the Fannie Mae team, the Georgetown team, Jack DeJoya, the number of people required to do this, and to our sponsors throughout the day, throughout the last 2 days, the number of people who put this on is enormous, and the amount of work has been enormous, and we really appreciate you, the crew, and everyone who's helped to make this possible. So we shall see you. Oh, one last time. Tomorrow, the city of the District of Columbia is putting DC into DC Fintech Week. And if you look it up online, Karima Woods, the commissioner, has an entire day of programming. I'll wake up hopefully in time to be on a panel to help moderate on social impact fintech as well, and later CBDCs. We'll have a special project over at Georgetown. But for the first 2 days are officially over, and look forward to seeing you guys all again. Thank you.